Welcome to The Explainer. Okay, let's paint a super familiar picture here. You finally decided, you know what? It's time to take control of my financial future and actually learn how to invest. So you jump online and boom, you are instantly absolutely bombarded. On one side, you've got folks shouting that stocks are literally the only safe way to build wealth. Then you scroll down and someone else is absolutely promising that crypto is the undeniable future of money. And right on cue, an ad pops up claiming you can make thousands a day just chilling on your laptop trading Forex. If you're sitting there thinking, okay, which one of these am I actually supposed to learn? I promise you are not alone. Today, we're cutting through all that noise. We're going to break down stocks, crypto, and Forex to figure out exactly what you should learn first, and honestly, more importantly, why.
Okay, let's dive right into this. Here is our roadmap for today's explainer. 1. The beginner overload. 2. Stocks, the reliable foundation. 3. Crypto, the volatile wild card. 4. Forex, the high-risk market. And 5. The ultimate learning path.
Part 1. The beginner overload. Trying to learn it all.
You see, the absolute biggest problem is that beginners often don't just pick one market. Because they're getting hit with so much hype from every direction, they try to learn all three things at the exact same time. And almost always, they kick off their journey by asking one fundamental question: which market makes the most money? No, I get it. That seems like a totally logical starting point, right? But honestly, it's actually a massive trap. It leads straight to confusion, intense frustration, and ultimately losing your hard-earned cash.
Chasing the absolute most money right out of the gate is a total recipe for disaster. It's just the wrong question entirely. The smart question you should really be asking is this: which market helps beginners learn the right financial habits? Because look, successful investing isn't about quick profits. It's just not. It is a long game. It's all about building vital skills, developing unshakable discipline, and actually understanding market mechanics. And the truth is, some markets are just way better teachers than others.
Part 2. Stocks, the reliable foundation. Owning real businesses.
So, when you buy a stock, you really aren't just buying some random ticker symbol blinking on a screen. You are actually purchasing a small piece of a real productive company. We're talking about massive businesses like Apple, Microsoft, or Amazon. When these companies innovate, grow, and become more profitable, well, the value of your piece tends to increase right along with them. Historically speaking, and this is a big deal, if we look at the S&P 500, which tracks the 500 largest companies in the US, it has returned roughly 10% annually, on average, over the long term. Now, at a 10% average annual return, your money historically doubles roughly every 7 years. That's huge. Yes, of course, markets fluctuate. You're going to have negative years, and you're going to have incredible years. But over decades, that 10% average is exactly what makes stocks one of the most reliable wealth-building engines in existence.
And there is a fundamental truth here that the internet so often totally ignores. Many millionaires aren't day traders. They are long-term investors. Wealth in the stock market isn't usually built by frantically buying and selling every hour of the day. It's built by consistently investing in productive, solid companies for years or even decades, and just letting the absolute magic of compounding do all the heavy lifting for you.
Part 3. Crypto, the volatile wildcard, the digital asset space.
Now, crypto is a completely different beast. Instead of owning a share of a traditional company that has quarterly earnings and a CEO, you're buying a digital asset. And it's super important to understand what actually gives these specific assets their value. Some of them act as alternative payment systems, right? While others are basically the fuel powering decentralized web applications. And let's be totally honest here, some exist entirely because of internet hype and internet dogs wearing sunglasses.
But why are people so drawn to crypto? Well, because it can produce gains that absolutely defy logic. Take Bitcoin, for example. Back in 2011, it was hovering around just a single dollar. Since then, it has traded well above $60,000 at various points. I mean, we are literally talking about one of the most dramatic, jaw-dropping asset price increases in the entire history of finance. It's that wild potential for extraordinary gains that pulls so many beginners right in.
So the crucial point is, for every massive rally, there is the potential for a really catastrophic crash. Bitcoin alone has dropped 70% or more multiple times in its relatively short history. And let me tell you, a 70% free fall is absolutely terrifying if you don't know what you're doing. Crypto is extremely volatile.
And while that volatility creates incredible opportunity for seasoned traders, it can absolutely destroy inexperienced investors who just don't understand how to manage risk yet.
Part 4. Forex, the high-risk market, trading global currencies.
Let's shift this explainer over to the third major market, Forex. Now, Forex stands for foreign exchange. It's the market where you buy and sell global currencies, things like the US dollar, the euro, or the Japanese yen. And the sheer scale of this market is honestly hard to even comprehend. Over $7 trillion is traded in the Forex market every single day. To put that crazy number into perspective, that is roughly a quarter of the entire United States GDP just changing hands in 24 hours. It is, without a doubt, the largest, most liquid financial market in the world.
But here is the catch, and man, it's a big one. To make significant money off the tiny fractional movements between these currencies, retail Forex trading relies really heavily on leverage. Now, leverage means controlling a large amount of currency, let's say $10,000, while only putting up a very small amount of your own money, maybe just $500. It sounds thrilling, right? Why wouldn't you do that? Well, leverage is a massive double-edged sword. Yes, it magnifies your gains, but it magnifies your losses just as brutally and just as incredibly fast.
And that brings us to maybe the most sobering reality of this entire explainer. Studies from multiple brokers consistently show that between 70 to 80% of retail Forex traders actually lose money. It's not that Forex is some giant scam or that the market is totally impossible to trade. It's simply that the risk level, when you combine it with that leverage, is just way too high for a beginner who is still trying to learn the ropes.
Part 5. The Ultimate Learning Path. Building a Financial Master Plan.
So, we've got three very different markets, all with massive potential, but with completely different risk profiles. So how do you actually navigate this? Well, if you're a beginner, the biggest mistake you can possibly make is treating investing like gambling, chasing the hype instead of the fundamentals. And this brilliantly illustrates the point. Learning to invest through the stock market, that's like learning to drive in a normal, safe, everyday sedan. You learn the rules of the road, you steadily build your confidence, and you understand the mechanics at a perfectly reasonable speed. Jumping straight into leveraged Forex trading, though, that is literally like trying to learn how to drive in a Formula One race car. I mean, technically, sure, it's a vehicle, but your risk of a catastrophic crash is astronomically higher because it demands total, absolute technical mastery from second one.
This is exactly why stocks are the perfect starting line. They naturally encourage a long-term mindset. You start thinking about actual business models, earnings, and true intrinsic value. And mastering these basics, it builds highly transferable skills. You learn crucial risk management, you learn how market cycles actually work, and you build the emotional investing psychology required to not just totally panic when a chart suddenly turns red. Once you have those core skills down, they transfer to literally everywhere else you want to invest.
Let's look at what that foundation actually looks like in practice. Imagine you invest just $500 a month into a broadly diversified stock index fund, averaging an 8% return. In month 1, yeah, it feels pretty slow, but by year 5, you are seeing some real momentum build. By year 10, that simple, consistent habit has snowballed to roughly $90,000. No, it's not an overnight get-rich-quick success story like catching a lucky crypto meme coin, but it is real, undeniable mathematical financial momentum. Let's move to and see how this builds into the definitive roadmap actually recommended by financial professionals. Step 1. Start with stocks. Build your foundation and learn those long-term basics. Step 2. Once you're confident there, explore crypto, but do it cautiously, treating it as a smaller, higher-risk portion of your portfolio where you can actually afford the volatility. And step 3, treat Forex strictly as an advanced skill. It should only be approached when you have deeply, deeply mastered risk management and market behavior.
Because look, over the next few years, new technologies are going to evolve, and shiny new financial trends will absolutely appear on your social media feeds. But you have to remember this core truth. Strong financial fundamentals will always, always matter. Your true goal isn't just to blindly pick the hottest asset today. It's about building knowledge, discipline, and momentum that compounds over decades. Because at the end of the day, that is what actually creates lasting wealth.
So, I'll leave you with this final thought to ponder as we wrap up this explainer. Now that you understand the underlying mechanics, the real risks, and the true purpose behind each of these financial arenas, which market interests you the most right now? Stocks, crypto, or Forex? Remember, your financial journey doesn't require you to figure out everything all at once. It just starts with choosing one solid thing to learn first. Thanks for joining this explainer, and hey, keep building that foundation.